You're listening to the All-Star Charts podcast with JC Peretz on technicalanalysisradio.com.
Hey everyone, welcome back to the podcast. I am thrilled to have my friend Todd Sohn on today, technical strategist at Strategas Securities. Todd, thanks for being here.
JC, thanks for having me back on. It's a pleasure.
All right, Todd, you're one of my favorite guys out there. I love your work. We could probably do a 5-hour podcast if we wanted to, but let's keep it short. Let's get right to the point. Last time you and I spoke, we were probably still in the midst of a bull market. We now looking back over the last year and a half, here we are in August of 2019. Over the last year and a half, most indexes are flat or down. Would you argue that this is a cyclical bear market within a longer-term structural uptrend, or you think maybe some things have changed?
I think the former, the cyclical bear, is our current thinking, right? Yeah, the brief 20% pullback in the fourth quarter of last year. S&P went on to make new highs, but has left behind a few indices. But that doesn't mean the run is over here yet. They could just be consolidating some massive gains off the December low, for example, small caps. So I do look at it as cyclical bear. But what I do want to mention here, what I think is really interesting, is some of the sentiment data we've seen not only this week, but in the last few months. If you want to touch on that right now.
Yeah, talk to me. What do you got?
So let's rewind the clock here about 6 weeks. The first half ended with the S&P 500 up 17%. Right, really good run for the first
year to date.
Year to date through 6/30/19. And what was interesting to us is that if you looked at total equity ETF flows, you had $41 billion going to equity ETFs. That's a pretty significant number. But what was more interesting to us is that you had $74 billion go into fixed income ETFs. It is rare to see on a semi-annual basis, rolling 6-month period, bond ETF flows outnumber equity ETF flows. Equities did outperform bonds in the first half, but just to see that extreme in bonds was really stood out to us. So even if we're in a cyclical bear market or you have equities at all-time highs, the euphoria is not there, right, for equities. What was also more interesting was that you had small caps up 16%, the Russell 2000, but you actually had outflows out of all the small cap ETFs, some $3 billion. So again, no euphoria there. So that was just for the first half of last year. More recently, right, we had this little 6% pullback capped off by Monday's 3% dip. If you took the rolling sum over a 5-day period of the S&P 500 SPY ETF, the NASDAQ 100 Qs, the Russell 2000 IWM, and the EEM, right, 4 liquid, actively traded ETFs, they had over $20 billion come out earlier this week. The only other time over the last 10 years we saw more was in January of 2018 during that little mean reversion when things got really hot. That was about $27 billion. So these ETFs, which I think everyone is almost using now, are reflecting some liquidation here. And let me just add one more point. I'll get back to you. On top of that, you had the put call data, put volume spike into a level that is very extreme this week as well. Historically, when you get these spikes, that's actually pretty bullish for the S&P 1, 3, and 6 months forward. So some interesting sentiment extremes as we're debating what kind of market environment we're in here.
So I don't want to put any words in your mouth, but it seems to me like you are leaning towards we are already past the cyclical bear, and that maybe that ended in December, and now we're in a new cyclical bull, or perhaps we're at the tail end of a cyclical bear and now entering a cyclical bull. Maybe one of those two. Do I have that right?
I wonder if it's a middle ground. It depends where you look. The S&P 500, I would say it is a new bull, right? We had all-time highs. But what's interesting is when you look at certain groups and certain stocks, and I'm happy to share this chart with you. We have a good scatter plot that shows a stock's weight in the S&P 500 versus the last time it hit a 52-week high. And on the left side of that scatter plot is names like Microsoft, Visa, MasterCard, your tech type names that are heavyweights and hitting new highs. On the far right side, though, I think this is probably where more frustration is coming from our clients, are names like JP Morgan, Bank of America, Citi, Pfizer, United Health, Exxon, Apple, Amazon, and Berkshire Hathaway. They haven't hit a new high this year. So there's portions of the market that are in a bull market, and then there's other portions of the market, like those names or like small caps, that are still in these cyclical bears. I think it's pretty impressive, though, that you did get large caps to new all-time high without those names I just mentioned to you.
And what's wrong with that, Todd? And why can't we have some stocks doing well and others poorly, like energy stocks? I remember years ago, I was talking with one of your partners, Chris Verone, and he was, I was a little pessimistic maybe on China or something like that. And he was talking about healthcare stocks and, how healthcare was in a bull and everything like that. And I'm like, Chris, what about China, though? It looks like crap. He's like, well, we're not talking about China. We're talking about healthcare. What does one have to do with the other, right? And that drove home. That was a long time ago. That drove home to me, don't overthink the intermarket relationships. Don't overthink the global macro. Look at what's in front of you. So if you're an energy trader and you're only trading energy stocks, of course you're frustrated as hell. But if you're in the tech space, you're like, well, market looks pretty damn good, right?
Yeah, totally. And it's a perspective thing. Of course, I want to see more and more participation. That's what makes these rallies durable and bull markets continue to run. But I think what you just said and what Chris said years ago, we should really just focus on what's working, and don't make things too complicated more than they should. Get that Chinese equities, even now, are struggling, right?
Yeah, exactly.
And that's a problem. It's a problem for EM. We don't necessarily need to make that a healthcare equipment problem, though. Right? Because those stocks are great. So, for all the listeners, especially some of the younger folks, just keep things in the fairway here. There's no reason to make a variable after variable after variable, right?
I have a really hard time keeping things in the fairway. I'm more of like I'm great at punching out, though. With all that practice.
Yeah, I almost wonder is because we look at so many different things, we lose track of the big picture, right? You can look at 1,000 charts a day, and the message may get lost there. So that is something we have to deal with, right? As technical types.
Let me ask you something, Todd. I mean, you always hear about these fund flows and outflows and inflows, and I just have never really been able to wrap my head around being able to use that data to help me make decisions or to help me manage risk. I haven't gotten there, and maybe it's on me, maybe I don't know what it is. Can you kind of maybe just dig in a little bit more and kind of explain to me how frequently you're analyzing that data? You mentioned what it might mean to you today. How has that helped in the past? Can you maybe shed some light on the value of this data?
Yeah. So we run a screen every day that highlights when flows are hitting extremes, right? The 95th percentile or the 5th percentile of all data that we have.
Just ETFs, though?
I prefer using ETFs because I think they're becoming a more and more important tool every single day, right?
Fair.
I would think the data backs that up too when you look at mutual fund flows versus ETF flows, how things are coming out of mutual funds and into ETFs. Now, I think there is some debate as the timeliness of them as a signal, right? Just because something gets extreme doesn't mean it's a buy or sell signal. But it can at least help tell the story of where there are extremes, and that's a data point we need to be mindful of. For example, in the bond fund saw $71 billion in inflows in the first half of 2019. That's the most in any rolling 6-month period. So clearly that's a starting point to say there's something going on here, and either we need to pay attention for more momentum to come in, or is there a reversion play happening? Let me keep going here on the bonds, right? So huge inflows into bonds. And now you have the TLT historically stretched above its 200-day average, right? You're, I think, 15% above a 200-day average on the TLT. Over the last 15 years or so that TLT has data, that's actually one of the higher readings. You can get a little higher here, but I wonder if this current move is reaching its last gasp.
Well, the TLT is back to the 2016 highs, right, where interest rates bottomed.
Yeah, and another that could be a point of resistance here for them to reverse. As we talked about variables before, if the TLT starts to come in here, what does that mean for some of the stuff we were talking about before, the banks, the energy, the material stocks? That may help them here escape these ranges they've been trapped in.
Just think about the move that we've seen in bonds this year, and even since the fourth quarter, but let's just say this year, and just think about maybe the resiliency of stocks, particularly the large cap indexes, in the face of such a face-ripping rally in bonds. If I would have told you coming into the year that bonds would be acting the way that they have this year, what would you have told me about equities? Would you have guessed that equities would have been as strong as they have been?
I would be hard-pressed to say yes, particularly when you look at global bond yields too, right? I mean,
yeah,
negative yield upon negative yield. I honestly would be hard-pressed to say yes. Now, here's where I think things may get a little tricky. You have the S&P in a little correction here, but our risk relationships that we look at, and I'm talking about consumer discretionary versus consumer staples, high beta versus low beta, semiconductors versus the market, IPOs versus the market, some of those have had more of a lackluster response, and I don't want to see those break down over the coming weeks here. That would cause me to be a little more hesitant on how we feel about equities into the back half of the year.
Let's talk about something else that's working, and that's the precious metal space. In a similar way that equities have held up well in the face of crashing interest rates for all intents and purposes, I find the strength in precious metals in the face of a dollar that isn't falling, at least with compared to developed market currencies, with a relatively strong dollar. I mean, making new 52-week highs over the last few weeks. Gold just absolutely ripping. Really interesting with a dollar that isn't falling, huh?
So I have a few thoughts on gold and the dollar here. Let's start with gold. Obviously, structural breakout. I think we've all seen that chart. Everyone's seen that. I'm a little worried that some of the ETF flows are getting hot there, just in a tactical sense. So maybe you get a dip, right back to call it 1400, 1350. That's okay. But here's a question that I frankly am not smart enough to answer. What is more important to gold right now? The dollar coming in or going sideways, or the sheer amount of negative yielding debt that's happening globally? Because now, in a way, gold has a higher yield than many bonds in Asia and Europe. I think that's something really important to consider here. That has never happened before.
I hadn't really thought
gold
of it
is
like
actually,
that.
It's a question worth considering here, that gold actually has substantial value in the face of what else you can look at besides equities. So in that environment, I have to say to myself, gold is something I want to own, right? I think that's a really important thing. Now, as for the dollar, when the dollar hit a 52-week high right after the FOMC meeting last week on the 31st, I think, and we were talking around the office, this is probably significant here that the dollar is actually going to break out and work. So I went back and I looked at every 52-week high for the US dollar going back 30 or 40 years. And what we found is, whereas with the S&P 500, a 52-week high usually means more 52-week highs are coming more often than not. High probability that you're going to be higher within a month, 2 months, 6 months, 12 months. With the dollar, 52-week highs are actually pretty all over the place. There is not a linear forward return like you see with equities.
That's interesting.
So that made me a little hesitant to say, just because the dollar hit 52-week high doesn't mean we're going to start to trend higher here. The probability is much lower than we're used to for equities. And you saw it right away, reverse. Now we're right back into that range. I don't have a great feel for where it goes here, but I just statistically am aware that dollar breakouts are very unreliable. And that supports gold again, which is good if you're bullish on that metal. I think it's also interesting that silver finally woke up too. I prefer gold, but if we're talking precious metal space, you want to see them both work.
In your work, do you find that when precious metals are doing well, silver's outperforming gold?
That's typically what you want to see, right? The higher risk, higher beta metal, silver working. Has that relationship started to change? I guess. Do I need it to have to happen? And this comes back to our keeping things simple. It would be a nice addition, but just because it's silver's not outperforming gold, I'm not going to get bearish gold. It just tells me let's allocate more towards gold. Does that make sense?
That's perfectly fair.
I think that's the way I'm thinking about it right now. Of course, you want to see the higher beta area in certain sectors working, but let's just go with what is actually working in the meantime before we get ahead of ourselves here.
Let's talk about things that are not working in the metal space, and that is Dr. Copper. I think it was Bruni. Dr. Copper needs some medical attention or something like that. I think he said. Interesting sentiment data going on over there with the speculators like crazy net short and commercial hedgers, flipping the book long on copper. Copper down near, seems like pretty good support from last year. How are you feeling about Dr. Copper?
Yeah, I agree on the speculator chart. For a moment, it looked like we had something. You broke down here. The copper-gold relationship, I think, is helpful for interest rates, right? And that's broken lower. I would like to see copper revert higher. I would guess if you can get copper higher, that would help the materials sector, maybe the energy sector, perhaps industrials. But the question is, if you do get some sort of squeeze here, is how far can we take it? Does it go back to the 200-day at was it 280, I think?
Mm-hmm.
Or even 300? That would be nice. But I need to see some sort of sustained type of rally there before I can really get more bullish copper. I think the copper chart fits in with these very mixed macro charts that we all look at, like yen, like Aussie yen. Oil does not act very well. So if you're big into the macro backdrop, you look at these charts and say things really aren't that fantastic in terms of these big trades, and whether or not they reflect growth expectations is up to you. So a very tough environment for those actively involved there.
The big macro guys in general, I don't want to generalize everybody. There are exceptions, of course, but I find some of the macro guys are leaning bearish because you're looking at the Aussie yen charts, copper, gold, interest rates around the world, and they're like, something's up, right? I think it goes back to what you were saying earlier. Try not to overthink things and trade what's in front of you. Stocks breaking out, a MasterCard or whatever it is, what does that have to do with Aussie yen, right?
Yeah, totally. I mean, don't get tripped up in these macro pairs of your ride on the stock that just continues to go up. You may, if you're trading Freeport or Southern Copper, you clearly have to pay attention to what's going on with copper and some of this stuff. So know the sector you're playing in, what it's actually related to. Like, for example, energy. I have a very tough time embracing energy because oil trades so terribly.
Mm-hmm.
Like, your biggest input into that sector is in a bear market. So clearly it's going to be a headwind for the equities. Whereas look at tech. Now, tech may be a government issue over the years to come, but I'm not going to worry about that for now. The stocks, for the most part, still act pretty well.
When you talk about Dr. Copper, it has that nickname, and people think that it's maybe something related with U.S. equities, or it's maybe like a risk-on picture. But the real correlation in copper historically is with emerging markets, right? So if you're buying what the commercial hedgers in the copper space are suggesting, isn't that positive for emerging markets? Are we finally going to get that rotation?
Ideally, yes, right? Of course, I want to see that. I don't want a scenario here where the S&P somehow goes on to make new highs, and let's say the Russell breaks out finally. But you have Europe and EM continue to roll over. That's exactly what happened in the beginning of last year and resulted in that nice fourth quarter correction. So if I can get copper up, I can get EM to work. That means Chinese equities, they're the pretty substantial weight there. They should start working. I know that it's more heavy tech now than it used to be. but I think that's an important relationship we need to watch. I think it is peculiar, especially in this environment now, while we're worrying about copper and what it means for EM. You have almost this bizarre leadership mix globally this year. China doesn't act great. European stocks are sitting at support, but I have leadership from Russia, I have leadership from Argentina and Brazil.
Greece?
It's just
Greece?
Yes, Greece is the other one. I knew I was missing one there. So this is an environment where you have to go super granular. I can't just say buy Europe because the weights are backwards. There's too many financials. There's not enough tech. And I have trouble saying buy. You can't go buy Spain, right? Because there's too many banks there. You can't go buy Germany because the autos are terrible. You got to go another level deeper to stuff that may not be liquid enough for some big institutions. But if you're an individual investor, there's opportunity for you there, and you got to really dig in and check out all these funds that are around it. But it's a very odd mix. I will just say that, given what we're seeing.
Well, the execution would be different. So while an individual investor could get involved in one of these obscure ETFs like Japanese industrials or something like that, the institutions can own some of the components where they'll find a lot more liquidity, maybe some of the larger components in those funds.
Yeah, that's
right?
true. That is true. Like global autos, right? They don't act very well, but there's some signs of life from Toyota, and randomly Kia Motors is another stock that's actually held up pretty well. So I get that that's something that they could go step into, right? There's usually one or two stocks within groups that can hold up pretty well, and those would be the ones you want to own, obviously.
And then what about if the dollar does roll over here and we do get strength out of euro? How do you think that will impact equities? Would you consider that more like a risk on sort of event or trend, or do you think one has nothing to do with the other here?
I think big picture that is what you said. It is a risk-on thing, and it should help European equities. I don't know if European equities will then start to outperform U.S. on this big structural basis. I have a tough time with that right now. But I would imagine, the euro is a riskier currency. Certainly when you see some of the headlines out there, I would think that's broadly bullish for equities. And what's curious about the euro, I don't know if this is true from this week's movement, but the volatility on that currency was very, very tight heading into the last few weeks. So that tells me there's some sort of big move coming here. It looked like it was going to be down for a very brief moment. Now we're right back into the range. So maybe this is the start of that big move coming here, squeeze higher, and ultimately getting the dollar lower too. I think that'll be a very interesting play into the back half of the year.
Do you think that gold's strength in the face of a dollar that isn't falling is relative strength for gold, suggesting we have substantially higher prices? Or do you think it's more of a heads up that the dollar's about to fall apart?
I think we can go with both. I'm impressed with gold's resiliency here. Each time you had the initial breakout, you chopped sideways for a couple of weeks. I thought that was going to be a little retest, and it didn't happen. I like that it's ignored any sort of rally in the dollar, and the fact that it continues higher, and the stocks too, the gold miners, maybe that's foretelling us that a weaker dollar is going to happen. It is some intermarket at its best, but it's super impressive. And I think we have to remember that gold was an asset that did nothing for 4 or 5 years, whatever that base length was. And you have to respect that, right? I know it's not everyone's favorite asset, but we're just looking for things that make risk reward skewed in our favor. It was there once you got over 1375, let's call it.
Yeah, that was my level.
Right. I think that was really important, and it took its time, and finally it's actually working. It's been a superb trade here for 2 to 3 months, I would guess. We were talking gold and rates before. I wonder, there's an ETF out there. I always like looking at these ETFs. That the ticker is EQRR. It does no volume, right? But I'm more interested in the underlying index. It is the 50 most correlated stocks to the 10-year yield. So You have banks in there. You've got, I want to say, Freeport or Southern Copper's in there. You've got some industrials in there. I would keep an eye on that too. If those stocks can subtly outperform here, that may be another tell on rates bottoming, or at least attempting to bottom, or some sort of reversion play. I just want to throw that out there. I think is another little intermarket thing we can pay attention to.
It's an interesting chart. So these are the stocks. So the ticker symbol is EQRR. It's a ProShares Trust. So it's called the ProShares Equities for Rising Rates. So you said it's the top 10 most highly correlated stocks?
Top 50.
Top 50.
I want to say they get rebalanced. Here, let me check. Is it a quarterly rebalance? I forget how they judge it, how they judge the correlation, but I'm sure it should be thoughtful. And I know the ETF, I feel like we actually all made fun of this when it first came out because everyone thought rates were going to actually go up. Now, the fund itself does not do huge volume, so I need to look at the underlying index, which is it's the NASDAQ Large Cap Equities for Rising Rates Index. So I think if you pay attention to that, it'll be interesting to see if it starts to outperform. It's sitting on the June lows right now, which is obviously not helpful. But that's a curious one. And I had come across it the other day, and the light bulb went off in my head here.
Yeah, it's really, really interesting, particularly since we're back down near those May lows. Interest rates are just really interesting here. What are you seeing on the sentiment side outside of the flows? Anything stand out?
Here's something I was thinking about yesterday, and I don't have any idea if it can become true or not, but I think it would be something else if you had what is basically a 40-year bond bull market. The only way for it to end is if you had the U.S. 10-year yield go negative, along with all the other interest rates we've seen worldwide, globally. I would call that the blow-off top in bonds and the blow-off bottom in yields, if that were to happen. I think there's something almost poetic for the bond bull market to go out like that.
Hold on a second.
Now,
So you're hold on. So you're suggesting U.S. interest rates that are around 1.7%, you think that they can go negative?
I wouldn't call it out of the realm. Now, I think that this view is becoming more and more consensus. Just watching the TV that we have here in the office, you have a couple of guys coming on, and they're very smart fixed income managers saying that it's possible U.S. rates will go to zero. So that idea is becoming a little consensus. But when I look around the world, I just see more and more rates going negative, and just pure gravity to me means U.S. will get dragged down to it. Now, there's quite the spread there. You have 170 basis points.
Yeah, I was going to say.
but I wonder if we just have to keep it in the back of our mind as one of those what ifs, and how do we plan for that? But for me, it would just be one heck of an end to a major bull market to actually see them go negative, and then you get some sort of squeeze higher, and that's it, and then the bull market and bonds is over.
Yeah, but there are steps. But there are steps before we get there. I mean, we still got to get to 1.4 where we bounced the last couple of times we were down there. I mean, we're not just going to go negative tomorrow.
No, of course not. I mean, it would be a process, a painful process, I'm guessing. But I would throw that out as just something to stick on the wall. Unless and the thing that would help change it is you got to get global rates up. We talked about it. Swiss 10-year yields are negative 100 basis points, or basically there. The entire German yield curve is now negative. So I think that needs to somehow change. I don't know how it does in order to help support U.S. rates going higher.
Let's talk about market breadth.
Yeah, things are difficult. I go back to this scatter plot thing here where there's certain areas of the market where it's tech, it is healthcare equipment, it is software. I mean, that's part of tech. Some parts of consumer that are working, and then you just have this whole other area that is not working. And the two charts I'm watching for helpful tell are the equal weight industrials, right? Major range over the last year and a half, and equal weight consumer discretionary. Equal weight consumer discretionary is just up and down. I can't look at stuff. Large cap discretionary is fine, but that's Amazon, Home Depot. I need to see those actually break out. I need to see the banks, and I feel like I have a little analogy there for you in a second. I need to see the banks break out. I need to see small caps actually start working. Until then, you have this almost bifurcated breadth market, you could say, and that is very difficult. As for the banks, my analogy for them is, and I looked this up the other day, the Society for American Baseball Research tells me that the most foul balls in one at bat is 15.
Wow.
Crazy. 15 foul balls in one plate appearance. It's happened one time. 14 foul balls has happened 3 times. 13 foul balls has happened 5 times. I say this because if you look at a bank chart, every single time they look like they're about to slug one out of the park, they roll over. And it has happened time and time again for the last year. Clearly frustrating. The banks just continue to foul off these pitches. I need to see them actually hit one in play. They're an important group, an important weight, and they're holding back the financial sector. And it's just amazing to me that they just cannot get their act together.
Yeah, but what we're talking about financials like traditional banks and stuff like that, which are complete disasters.
Yeah.
I mean, they just suck at everything, which is cool. A lot of us root against them. Like, it's pretty funny, actually. What's actually working, however, is the technology stocks within the financial, like the mobile payment stocks and things like that, right?
Yeah.
So, but those are like kind of like, those aren't really financials. They're more like tech stocks, right?
They're listed in another sector. You know, if you go by the GICS playbook, you're stuck without them. Now, I think insurance stocks have been pretty good.
Yeah.
The exchanges are really good,
Yeah.
and more financial data like an S&P or a MSCI, right? Those have been really good. It's the banks and the asset managers that are just getting absolutely crushed, and they're holding back that whole sector. And they're the largest weight. I mean, they're probably half the index at least, I think, off the top of my head.
Yeah.
So if you've been trying to wait for these banks to work, you've just been home to frustration. And particularly, even if you go further down the scale, the regional banks have just been another disaster in itself. And that's another reason why small caps can't work either, because there's substantial weight there too.
Yeah.
So if you're playing financials, you gotta go more granular here. Again, you gotta look at the industries, the sub-industries, look at all the different ETFs available to you and say, I need to be more tech involved than traditional money center type banks here.
Seems to me like if the U.S. interest rate situation is not one of those negative outcomes where the U.S. goes negative like everybody else, and this same high in TLT a few years ago is going to be the same high now, and rates start to move higher, you would expect both regional banks, financials, and small caps perhaps to start their outperformance in an environment like that. And then if you're right, and I'm not saying that you're right, but if the negative interest rate sort of outcome is indeed what is in front of us, then further underperformance from regional banks and small caps should be expected. Do I have that right?
That makes sense to me. And it wouldn't be just banks, it'd be high beta versus low beta. I think that's another relationship that moves along with rates.
Yeah.
So then you're looking at what else is in high beta. I'm going to guess there's probably some energy or some materials in there. There's probably some industrials in there. So you're talking these other sectors remaining either in ranges or at worst, they break down. Like I look at Caterpillar. Caterpillar's sitting on the June lows here at the bottom of a range. I don't want to see that stock break down. It's important stock for the industrials. So the direction in rates in the next few months, I think, is going to somehow indirectly impact market breadth if we somehow tie those two together. And it'll be a very important development here, at least by our work, right?
Now, let me ask you this. What about we're talking about the ratio of high beta to low volatility and how, that risk on, risk off measure has just been a disaster, and it looks like rates, right? Those charts, a lot of them look similar. What about if we take the low volatility index on its own and talk about just how strong it has been? What do you make of that on an absolute basis?
If you're just looking for things that work, I like it. But when I look at the constituents,
and what's wrong with looking for things that work?
Yeah, exactly. Well, people like to make things hard on themselves.
Yeah.
Now the issue with it, I'm pulling up the data here. I think the issue with Boval is what's in it, right? Is it the percentage weight
Coca-Cola.
here? Yeah, 20. I'm looking at SPLV right now. It's 25% utilities.
Yeah.
I just don't know a lot of people who love buying utilities. It's 21% REITs.
Bond
REITs
bulls.
have been, yeah, I mean, REITs have been phenomenal, but I just can't find many people who get over their skis on saying I'm buying utilities and REITs. Like I am in love with these companies. And then it's 10% staples.
It's just another
Yeah,
interest rate story.
it's a rate play, and I'm okay with them being strong on an absolute basis. Like that's fine. That's participation, but it's when they start outperforming the high beta names or just a general market that says to me we may need to skew a little more defensive here in terms of leadership and perhaps in our market outlook, right? So that
But
it's
do
an
we?
important
But do we?
relationship.
But do we? Or is this
I,
really just another interest rate story?
I think it's both. It's definitely an interest rate story, right? But if I start to see staples, REITs, utilities meaningfully outperform, they have not yet. They've been range bound on a relative basis. So they've meaningfully outperformed. That's a defensive stance for the market. And I just want to be on guard that there could be some sort of pullback on the horizon, right? Does not have to happen, right? You can have these defensive groups lead on legs higher. It's just not the preference for many people.
One thing you told me, changing gears a little bit here, I'm pretty sure you mentioned this about a year and a half ago or so, I want to say. You said, you made a really solid argument. You're like, JC, I just have a hard time believing that this structural bull market in equities as an asset class is going to end before Europe has its breakout. I think you were specifically referring maybe to the Euro 600, Eurostock 600,
Right.
which is basically, as the S&P 500 broke out in 2013 above the 2000 and 2007 highs, as we all recall, Europe has yet to do that, particularly the Eurostock 600. Are you still in that camp? I still remember you saying that, so it definitely had an impact on the way I've been thinking. So I thank you for that, but I'm curious to see if you have any follow-up on that.
I appreciate you remembering that. It's important. That's nice of you. I think that's still the case, but the fact that it did not break out is a little troublesome. You're in the red zone, and every time you get in the red zone, the pick six is thrown. It's amazing. And my problem is the weights there. If you look at European financials, they are just god awful, and they are one of the largest weights in that index. Whereas the tech stocks are only like 5%, so they're
Right.
playing, 4 on 5 or with 10 men instead of 11, whatever analogy you want to make here. I think longer term that is still the case, but I obviously just want to be on guard that if they roll over here, then maybe we have to reassess that. Or maybe you get some sort of, this cyclical bear type of environment continues. And then that goes back to saying, well, if Europe can't break out, let's at least pay attention to what works in Europe. Like we talked about Greece, if you want to go a little more developed, how about Swiss stocks? Swiss stocks, one of the first ones to break out.
Yeah.
They're home to healthcare, which European healthcare is leadership. They've got 2 or 3 big names that have acted pretty well. So while we're waiting on the stock 600 to break out, instead of allocating directly into that, go one leg lower and find the countries or the stocks that are at least are working there. But in the short answer, yes, I would still stand by. How can this major run in U.S. equities end without this finally breaking out, right? And at least having some sort of durable run? And I almost wonder if you can say the same for Japan. But that's light years away from 1989 highs. But you almost have to wonder if there's another gasp from, say, Japanese equities left in there too.
It's so interesting. A little off topic. Remember in the 80s, I don't want to say I remember, I was like 7 years old. But I've gone back and done the homework, where in that bubble there was one park in Tokyo that the real estate of that park alone was worth more than all of the real estate in California combined at one point near the peak of the bubble. I've been to that park. I mean, it's nice, I guess.
I mean, that's a sign of a bubble, of course. But I will say they upkeep the parks and the recreational areas there very well.
Listen, man, I have nothing bad to say about that country. I am obsessed with Japan. I mean, between the food, I went to the sumo wrestling championships. I mean, this was like this is like nothing you've ever seen before. I'm such a huge fan. So when I make fun of the whole bubble and park situation, I say that out of love, because I thought it was fascinating how this little park. It's not even that big. It's not that big. We're New Yorkers. We're used to Central Park, right?
Oh, yeah, I mean, different vibes.
All right, Todd. Listen, we can do this all day. Obviously, I want to ask one of the questions from your buddy Tom Bruni.
The greatest headline writer of our time.
Oh, Bruni, he's hysterical. I can't get enough of it. He wants to know, because I tell Bruni, I'm like, Bruni, I got Sohn on the podcast. What should I ask him? So he says he's like, JC, I'm too busy right now. I don't have time to figure out questions. I'm like, all right, sorry, bro. So one of the questions he did ask was, he said, what do you use to keep the long-term trend in perspective when there's just so much noise out there?
Right. Okay, so I think the simplest way is just use a monthly chart with a 1-year average, a 10-month average. How about that? I mean, is that fair game? As long as you're above that average, things are in pretty good shape. And when you start to trend below it or cut below it, then I start to worry about stuff. I think that is the most automatic. I don't have to think about a zillion different things and trend lines and whatnot. I think that might be the simplest way to think about it.
Okay, so hold on. So you're talking about using a 10-day moving average, but for monthly charts. So you're looking at monthly candles and have a 10-period moving average on it. Do I have that right?
Yeah, 10 period, 12 period, anywhere between 10 and 15 months, okay, I think is fair game for talking long-term trend. And if you're above that, you're in good shape. If you're below that, then you're in some sort of correction, I would guess. And it at least tells you to take your foot off the gas. And I would take it. It's gotten you out at some pretty meaningful peaks too.
Yeah.
You briefly cut below it in the fourth quarter of last year, and then you're talking about a 12 period here. I got up on my chart. You went back above it in February, and you've flirted with it a couple of times here the last few months. But I wonder if that's the simplest way. The other way you could look at it is, structurally, the December low is obviously going to be important in terms of bull market thresholds. But then, you start to bring in trend lines there and retracements and whatnot. So I'm just talking the simplest way I can say yes or no, things are good. I see you go with the moving average scenario here.
So just a 10 to 15 period simple moving average on a monthly chart. Yeah. Keep it simple, stupid, and it'll keep you out of trouble at the very least.
And that's the way I view it. I just think if you make it 24 months, now you're too much leash. Too much. The decline will be over by the time you cross underneath it, and the whole point of the signal is gone now. So I have found that 10 to 12 month fits what I'm comfortable with in terms of just long-term trend, or at least the type of environment we're in.
On a closing basis, or in general, a few closes. Come on, Todd. I can't make it. I can't let you off so easy. What is this? Basic cable? Come on.
Closing basis. So if you want to get fancy, you could say the first close underneath it, you take half off. The second close underneath it, you take everything off.
Ooh.
I almost wanted, you get a little. That's a little fancy there. You're throwing in some extra ingredients in the dish.
It's like that guy is sprinkling salt, right? Like that.
Yeah. Oh, yeah. The Turkish guy. Now you have to do it at the end of the month, though. Don't do it mid-month because you'll get chopped up that way, right?
You can't be looking at monthly candles in the middle of the month, right? You go blind if you do that too much, right? That's what I heard.
Yeah. Well, if you cross under this 10 or 12 month moving average in the middle of the month, and then all of a sudden you reverse higher and you're out, you're gonna be pissed. So you got to follow the rules.
All right, Todd. We got a lot of young listeners out there around the world. It's interesting. I found, when I've traveled around the world, I find on a per capita basis more interest on podcasts in general, not necessarily just mine, but just in general, than I do domestically. I find it really interesting. I mean, that might be purely anecdotal. I don't have real data, but that's sort of kind of what I've observed in having conversations with my.
I can understand that.
Yeah, you would agree with that?
Growing. I mean, I don't travel internationally much, but I just think it's a tremendously growing segment.
So for the younger listeners out there, I mean, you've been in this business for a while. I think you're one of the best out there for sure, you and your partners. Any advice to a young lad out there thinking about getting more into technical analysis, getting into more of our business? What would you tell them?
I think you study up, read the books, but more importantly, focus on building your network. And you and I'm pretty sure built our relationship over just sending charts over email. Limited text, right? I don't need to send you 4 paragraphs saying, here's my life update. I literally just send you a chart and we go back and forth. So I would tell anyone out there, whether you want to talk to me, talk to you, just send me a chart. And that's how our dialogue works. Don't send me a 5-paragraph life update. That is the beauty of what we do, is that is all visual based and can be explained in very quick manner. And I can just go back and say, well, you sent me a cool chart. Here's my cool chart. And I think that's how you build relationships. So consistently network. Go to our chapter meetings for the CMT, even if you're not a member too. I'd throw that in there.
Yeah.
Or any other events that are going on around your town. Just introduce yourself to people. I think it's simple as that. You just have to go out there and talk. And then use the visual aids that we have, the zillion charts that are out there to help build those relationships.
I think that's great advice. I couldn't agree more. Mr. Todd Sohn, as always, it has been a pleasure. And from the bottom of my heart, I really appreciate you coming on the podcast. Thank you.
I appreciate the time, JC. Thanks for having me.
All right, let's do it again soon.
Thank you for listening to the All-Star Charts podcast with JC Peretz on Technical Analysis Radio. To see all of the charts mentioned on today's show, please visit allstarcharts.com/podcast.